Alrighty, there we go. How's everyone doing? Let's get audio check here. All right, hope you guys are all doing well. Running a few minutes late here, just getting back from the usual Sunday afternoon lift. So hope you guys are doing well. Ready to get back to it here for this week. As always, we're going to be covering weekly outlook as it relates to dollar, bonds, equities, as well as any questions that you guys may have. So as usual, you guys usually bring some good ones, so I'll touch on those then as well. And then I'll also share some things going forward. I'm sure you guys are seeing the metals market, and I know we've been talking about that really this year. No one's been more of a raging bull on metals than I have, and there's a lot of reasons behind that, and I'll share some of that with you guys here today, so you guys can have that also going into the new year. Also, a new YouTube video will be out as soon as we get done here with the live stream. My team's going to be uploading it right away. So for the last video of the One Setup for Life series, where you guys will be able to see actual executions of me using the model. So if you've watched the first 5 videos, you know everything you need about the model. Now I want to show you guys it in action, just like those I work with at the mentorship level. They see it every single week. Live trading, everything that goes into it, wins, losses, but consistent profitability. And I want to make some of that available to you guys, and you guys will see that in the video that will be uploaded here after the live stream. Also, in addition to, I'm going to give you guys some mindset things to think about at the end of that one as well. Many, especially when we first start, we think it's just entries. I need the pattern, I need to understand the charts, and that's it. But what you're actually going to understand is that the chart's is only 20% of it. The 80% of it is psychology, what you focus on, what habits you have, and how you conduct yourself as a trader. And those are all going to have much more of a determination on your success than the strategy itself. So also give you guys some mindset, psychology things to think about, so that as you guys now have this model, you learn how to read price really well, you can also have your mindset in the right direction, which that's all psychology is. Don't focus on the dumb shit, focus on the right things. And I'll also give you guys some of that at the end of the video as well. So with that, let's go ahead and get into it, guys. Let me pull up the chat here real quick. Alrighty, awesome. Let's get into it. Rhino, Portuguese subtitles. Okay, so shout out to the Portuguese folks following us. A couple of you guys for sure. Eslam, what's going on, brother? Joe, happy to be here, my man. Doing fine, doing fine. Glad to be here. Professor, good day to you. Dylan, this is the second full year of watching you. You helped me get my first 10,000 ever in my life. Very happy to hear that, and happy to have played a small role in your success and what's going to be a lot more success. That's just the start. And when you start making money and you have the skills to do it, what you really open your mind up to is how fast it can come in, right? When you're trying to get there, you're trying to see that initial profitability. It feels like forever. It feels like you're never going to make anything in this. But once you start making and you have the right habits, the right mindset, you're doing the right things, it is amazing how fast it comes in. Very happy for you. Keep up the awesome work and keep me updated. Happy to hear you're doing well and excited to see what you do with it. All right, guys, so let's get into the money making shit here. So let's start from the monthly chart here. So last week, we talked about how we ran out this monthly high here, and now we are looking for lower prices. So the month of December, we have been bearish, looking for lower, and we're seeing that monthly expansion here taking place. So after taking out this high here, if you guys remember about a month ago, once we were taking out this high, I wanted to see how we traded there. Because if we're going to get up into this monthly imbalance here, then it needs to accelerate above this high and make a run for that. Trading above it, breaking down, that's not what you want to see. That's more turtle soup reversal style, not continuation. So that's how we were able to frame that reversal and look for lower prices. And looking for that to continue here on the monthly chart. Not a whole lot of detail in here because we have been consolidating for the past about 7 months. We've been sharing the same range of candles. So there's not a lot of detail, PD arrays, market structure, order flow to really look at on the monthly chart. So that's where the weekly is going to come in. That's why we refine and we do top-down analysis. So let's get this on the daily chart here. All right. So key levels going into this week. Well, first we'll touch on last week and then we'll get into what we're looking at here for the new week. So we ran out the high here. We then broke down. So the last 2 weeks of bearishness on dollar, we've been all over that like white on rice here. So highs taken out. We broke below this inversion fair value gap. I have it labeled IFVG here. The reason that is an inversion fair value gap is because when the market was bullish, you see how it'll use it as support to reach for the targets we had, which was this high when we were bullish. Once this high was taken out, we then saw a breakdown. And if we're going to be bearish and attack the discount levels that we'll talk about here in a moment, if we're going to get down to those levels, it goes without being said that this gap is not going to support price. But what's interesting is how you can then use that information, because then what it'll act as is the way it acted as support here, using kind of retail terms. The way it acted as support here, you'll see how it then is used as resistance here on the sell side of the curve, or when the market is bearish. So very interesting insights there. So we opened, traded higher, sunk lower into the daily low here that we'll see, and we traded down into this weekly down close candle, which is a bullish order block, which we had as a target as well. And you see we nicely made the low of the week there. Going forward, what I'm going to be watching for downside targets, we'll cover that on the daily chart here. All right, so last week on the daily chart, we talked about the premium and discount levels that we were using. So last week, the premium arrays that we had was this daily fair value gap here. If you guys remember, one of the factors for this fair value gap being a QnA in my analysis is the fact that it also overlaps with the breaker here, which is this down close candle here. Extend that through, that's going to be a sell-off. So the premium arrays that we had last week were this fair value gap here and this bearish breaker. The discount arrays, or the levels below market price that we're looking for the market to trade into, was this low here and this low here. But if you guys remember the specific words I said last week, because this is a long wick here, I don't have to have that low delivered. We were looking for midpoint of the wick, right? So now let's get out of market replay here. And then you'll see we nicely made the low of the week inside this wick, attacking the low, but not getting down to the low, but stopping at a key reference point that we look for. So for some of you guys, especially if you're new here, you may be thinking, oh, well, this is a lot of complication, right? Premium array, discount array, all these fancy words and stuff like that. And I admit, right, trading with precision is not for everybody. Knowing where the high of the weeks are going to form, when those high of the weeks are going to form. If you're in the free Discord, you guys also learn that as well. So if you guys see the lesson I shared with you guys this week on the education channel, as it relates to making and framing the highs and lows of the week and when they're made, you'll see how it beautifully comes together. So Tuesday high of the week inside the premium raise we're looking for, and then making a low of the week inside the discount levels we're looking for. Knowing highs and lows of the week and where those levels are likely to form and when they're likely to form, trading with that kind of precision isn't for everybody. And if that's how you feel, that's fine. Trade indicators, trade other things that are more simple. And then with experience, then you'll see what'll be the best for you. So now going into this week, with that in consideration, we talked about 2 weeks ago how this would be the low risk sell in the market maker sell model. Beautiful. We talked about how this would be the first stage of distribution here inside this fair value gap and breaker. Here, beautiful, nice swing high inside that level. And now what I'm looking for is how we trade inside this fair value gap here. So I'm going to take these levels off here because they're not as consequential to me anymore. So this is the level I'm focused on here, this fair value gap. So ideally we'll leave some of it open, right? Kind of like this one up here, how we left that open. That leads to nice price runs. So ideally we'll leave some of this daily fair value gap open, more specifically the upper half. And then downside targets, so those would be the premium levels I'm using this week, which would be this daily fair value gap, and this mitigation block here. You may be asking, why is that a mitigation block? Well, these down close candles here was the bullish order block that took price higher, right? See how they dropped it down into it? Smart money bought the bullish order block, took it higher. Well, now those same levels on the sell side of the curve become resistance, right? Very similar to what we did last week here with the breaker, right? So the breaker here, extend that through. Right? That's an order block on the buy side of the curve when it's bullish, but you'll see how they'll use that to mitigate and sell off here on the sell side of the curve. So just some more market maker model components. I know we were talking about that last week, so you guys can see how that comes to life every single week. So now going into this week here, again, this fair value gap here is going to be key, but also because it has this mitigation here on the left side of it. So 2 factors aligning. And that's what you're really doing with the market maker models, is matching up both sides of the curve. So with that in mind now, we dropped down, we hit our discount target last week, which was the 50% of this wick here very nicely on Thursday. So time and price aligning when we expect highs and lows of the week to form. Now, what I'll be watching going into this new week is, again, how we trade inside this daily fair value gap. Preferably we'll leave the upper half open and untraded too. Definitely want to see that with the body, but the wicks can trade up into it and still not upset any bearishness. Discount levels, if we stay below the premium levels, the levels above market price that we talked about, will be this low here. So this sell side liquidity daily low, we'll just call it the 98.00 big figure number. And then through that, we have this daily gap here. So you see below this low here, what's the next key level we come to? It's this inefficiency here, where we gapped higher and just ran. So there is a void, a liquidity void, where no trading is. So if we accelerate, or no trading is taking place rather, here. So if we accelerate through this low here, my attention jumps right to this inefficiency here. Through that, we then have the lowest body here, and then again, the same procedure of splitting the wick. Like you see, you want to do that. Imagine being in a beautiful short. Not that we trade dollar, but imagine if you were in a short here, and you thought, oh, well, I need the low. I need to watch the live stream and understand that that wick is a key level, right? then you give back profits. So understanding where these wicks are key, and obviously knowing how to use them as well. So these are the downside targets if we stay below this level, and that's what we'll look for. Dollar continuation of the market maker sell model here. Hey, Reaper, yeah, it's been a while. Glad to have you. Now dropping down into the 4-hour chart here. Yeah, so now the fact that we have a bearish order block here on the 4-hour inside. Sorry, I have these huge monitors, so I gotta be mindful to zoom in so you guys can see it as well. So these two up close candles here on the 4-hour chart, the fact that that order block is happening in the lower half of that daily gap, even more reasoning and confirmation for why I'd want to see the lower half respected and not get into the upper half. And that would leave that open as a breakaway gap here, which is exactly what I'd want to see with the rollover here on the downside. And then again, the same levels we talked about in the daily chart are still pertinent on the 4-hour. But actually here you can see a bit more detail. So here you can see that full void here. So from where we closed this day, here, 1 second. So from where we closed to where we opened, no trading is printed inside this range. So now you can see there's even a bigger level for the market to want to work down into. So that's going to be a nice draw going into this week, as long as, again, this daily fair value gap is respected. And you guys can see how for foreign currency traders, the bearish bias for dollar. Easy money for you guys going long euro and long the pound. Definitely don't want to be the guy trying to short euro when the dollar is bearish. That's no fun. All right, so back to dollar here. Let's go over to bonds. All right, so bonds are rolling over. I know we talked about this last week, how bonds are trading with the dollar. And if you guys remember, I told you guys about that last week. That's okay, because we're just looking at the price action. So yes, theoretically, the fundamental relationship is bonds lower, yields higher, dollar higher. But we're actually seeing what? Yields higher, treasuries lower, and the dollar lower as well. So we're seeing intermarket decoupling. We're seeing an inverse relationship of what we normally would like to see. However, that hasn't tripped us up. We've been bearish looking for lower prices in the bond market because of price action, right? So working down into the, well, actually, I'll touch on the weekly chart. Guys, for those of you guys that have been working with me that went over the month 4 content with the institutional market structure, you guys see how we talked about that earlier in the year here. We'll just look at the 30-year here. And although it's inside this large consolidation here, still able to frame out price swings, right? And we talked about way earlier in the year, this long-term high here, because it's nested between an intermediate and another intermediate term high. And now the fact that we're breaking down with this market structure, it signals the market is poised for a large price swing whenever you have market structure aligning like that. So intermediate term high here, broke down. This fair value gap here is now going to act as an inversion fair value gap, very similar to the dollar example we just talked about. When it's bullish, it'll use it as support to rally. When it's bearish, it'll use it as resistance to sell off. So I will be interested in monitoring how this relationship continues with bonds and dollar, because we are seeing a disconnect there, which normally we don't see, right? Normally it's a confirmation where if I'm seeing lower dollar, I want to see bonds trading higher. So the fact that we're not seeing that intermarket analysis is very interesting, to say the least. So dropping down into the daily chart here, and this is how you work through the time frames top down. We talked about this fair value gap up here. I think last week, maybe the week before. Well, definitely the last 2 weeks you've been watching it, but I know last week we specifically talked about how, you see how it stayed in the lower half here and turned right at the midpoint there, broke. And the fact that it left it open indicates it's weak. That's why we want to see on any time frame, right? This is the same thing I'm doing every single week with my mentorship group on a 1-minute chart, right? We're doing these same things on 1 minute, 15 second, 5 minute, 15 minute, and you guys see us doing it here on daily and weekly charts. So once you learn how to read price, all you're doing is working top down, and it's information that should nest together with your understanding of top down analysis, because the higher time frames are parent to the lower. That's why you start top down. So with that in mind, we broke down here, imbalanced, retraded up into it, left the upper half open. We broke again, another shift in market structure, really indicating this thing is bearish. Retrace into this fair value gap here, which was also left open. That's important. And then another breakdown here, retracement, bearish order block, hit that up close candle here. As you can see very nicely, delivering to that opening price and then selling off here. So for bonds, we're looking for lower prices. Nothing in this market structure is bullish, and it is overwhelmingly one-sided and bearish. So my draw here would be the relative equal lows down here. What is interesting to note, though, is the other Treasuries, the 10-year and the 5-year are not showing that same weakness, but they are starting to roll over now, along with 30 years. So it'll be interesting to see what that does going forward. How about some 50-year mortgages? How about that? All right, so bonds, dollar. All right, let's go over to NASDAQ here. Okay, and take this off the weeks as well. Just had to get my annotations organized. Should do that before. I'm very unprofessional. All right, guys, so looking at the weekly chart here, or monthly chart rather, looking at the December candle here, generally what I'm trying to do on the monthly chart, and generally what I'm able to do going into the second week of each month, I'm able to have a good idea of where that higher low of the month is going to form. And usually then I'll give you guys that information. Like, okay, for example, this month here in October, we talked about how we dropped, very likely priced in the low of the month, and then we work with that bullish bias for the rest of the month. Right now, I don't really have that. Part of that is because we're also in December. So we could very well, like it would not be out of the ordinary or out of this realm to see the monthly December candle stay inside November's range. So we don't have to break the higher or the low. Now, with world events and everything going on right now, for example, you know, Venezuela, what's going on with Taiwan, and just a lot of other things as well. Could we consolidate? We could. Seasonally, that's generally what's expected. But given the global geopolitical climate right now, that might not be reasonable to expect, and we might see a lot of wild volatility. So just some things to keep in mind. These are things I'm weighing out because generally December into January isn't a whole lot of action, and it very well could just leave this high and this low intact going into the close of the year. Now, that doesn't mean there's no opportunity, because as a scalper, there's opportunity every single trading day. But for sustained price runs that you're going to see magnitude on that weekly and that daily chart, that's just not likely to manifest, at least as of right now. So I don't have a good idea if we have a higher low of the month. And one of the things I am considering is we could also stay inside November's range. So let's refine that down to the weekly chart here. And let's also get this off the weekly here. There we go. All right, so now we're also banging around inside this range as well. So one of the things I was watching, we'll touch on the SMC divergence when we get down into the daily chart here. So last week we saw the candle open, trade higher, sweep previous week's high, and then strong breakdown back into this bullish order block here. So as of right now, in my analysis, it's 50-50 on the weekly chart because we're trapped right now. We're inside this bullish order block here, which the week before we opened, dropped down, used it as support. That helped us frame the low of the week and then trade the expansion higher. However, we've already worked into that order block. So coming back down into it isn't something that's ideal for our analysis. And also, this last up close candle, you see we traded up into it, and it gave what? Premium sensitivity, meaning it sent price lower here. Let me see here. And then you can see we respected the lower quadrant of it here. So we trade up into this weekly bearish order block here, stayed in the lower quadrant and broke. And now we're back inside this weekly bullish order block here. Whenever there's a conflicting analysis like that, like there's, for example, a bearish and a bullish order block, and I'm 50-50, then the only thing I usually do is go up to a higher time frame, because the monthly chart will be the deciding factor in which direction this market will go. But because I don't have that clarity either, now I have to refine further down to the daily chart. And now this is where the insights are going to come in. So going forward into this week here, neutral to bearish. Looking at what we did last week, we were talking about the market wanting to trade higher into this gap here, right? Because we were seeing bullish order flow on the daily chart. We had this down close candle, this fair value gap here supporting price. Everything was bullish, right? Pointing higher. So then we were aiming for this high here, which we then saw delivered. Very nice. And then we were then looking for this inefficiency, right? Because we already took the liquidity here. So what else is there above the market for it to reach for? The inefficiency here. But then we see on Wednesday, here, if we zoom in, on Wednesday, which was FOMC, we fell 9 points short of it. So 9 points short of the weekly objective here, but we did get into the previous weekly high. So the previous weekly high was taken out. So we did have some targets delivered, but it didn't deliver up into that gap that we were looking for. Then after failing or showing an inability to even get into that gap here, we saw a strong gap down on Friday. And Kareem, I think this will get into your question as well. As I kind of recap last week and what we're seeing, this should also get into your question as well. But I will also get into the specifics of institutional order flow that allowed us to see this would be a big down day. But I'll get into that in a moment. So we traded up into this high here, failed to get into the gap, and then we saw a gap down. Then we broke aggressively on Friday, trading through this down close candle here on Monday and this fair value gap here, which was formerly an inversion fair value gap, right? When it was bearish, it used it, sold off. When it's bullish, which we were the last couple of weeks, the market gets above it, uses it as support, rallies, right? And then this is when it was an inversion fair value gap. But now that it's back below it, it's a reclaimed fair value gap. So what I'm watching going into this week, the premium levels I'll be using will be this reclaimed gap here, extending that through, and more specifically, this premium wick here from Thursday. So if we're going to be bearish, I want to see the market stay below this fair value gap here, and more specifically, stay in the lower half of this wick here. If we do that, then that's going to be a straight shot lower into this daily fair value gap here from the 25th of November. And then for the other discount levels will be this down close candle here. So the fact that this down close candle, you see that opening price is in close proximity to this daily fair value gap, I really like that as a draw. Then from there, we have this discount wick here to concern ourselves with if we trade through the daily bullish order block. And that would be this wick here would be the next key level. So these are my discount arrays on the daily chart. Then if we lose these levels here and we really start to see some ground through that, then we could potentially look to probe the low here. But as of right now, we're in the range, right? We're in the range high, we're in the range low. So as of right now, my visibility is limited to these levels. Then how and when we trade there, I'll have to see what information we get at that point in time. So those are the premium and discount levels for the week. All right, working down into the hourly chart now. Seeing this daily gap here that you can see in purple, you'll see how we use that on Friday. Joe, you can see why I was saying on Friday, we were looking for the lunch lows here, and you can see how the market was bearish from 1:30, which is when the PM session starts for us. You see how it's expanding lower into this low here at 12:30, and then didn't get down to this low at 11:30, but it was probing for it. It was reaching down for it. So that's why we were talking about the bearish bias in the PM session. We were in the Discord chat, and it was because of these factors here, right? So you can see how getting below that daily gap, which is a key level in our analysis, and then seeing the market trade up into it, respect the lower half, that's really weak. That's bearish. Furthermore, we take this level off here for a moment, you'll see we now have this hourly fair value gap here as well to concern ourselves with. And it does what? It trades up into it. But what do you see the wicks doing? Staying in the lower half. Furthermore, here we now see the bodies stopping at the low of it. So this is a market that's indicating it's weak, it's heavy. So you don't want to try to be in here on a 1 and 5 minute chart trying to go long here when you have these signatures as an underpinning behind what it is that you're doing. So just something to keep in mind there. And something to keep in mind, but that also for your trades, but also going into this new week, that also lends to my analysis. So now we're seeing what weakness, right? This daily gap staying in the lower half, this hourly inefficiency also staying in the lower half, leaving it open, signaling it's a breakaway gap. And then we have these daily levels here on the downside. So based off the market structure here, we could be poised to drop off the open. So maybe we could see something. And again, we never know where they're going to open it, especially with the eventful weekend that we had. We never know where they're going to open the market on Sunday. But there's different scenarios I might look for. So if we gap down, try to fill the gap, say in the lower half, then roll over, that would be really nice. However, I want to see it stay below this daily reclaim gap that we talked about here. Gotcha. Yeah, I saw that later. There you go, man. Most important thing is that you saw it after. Next time, you'll be seeing it ahead of the time. So as long as we stay below this daily gap here, which I don't even think we should trade back into it, given what we already saw here. I mean, it can, though, going into London session. And then the daily discount levels would be these levels here for a drawn liquidity to the downside. And all these factors here further communicate the bearishness. So just looking for a drop straight down into the discount levels that we have here. So there's NASDAQ. Yeah, so I said we'd talk about the S&P as well. So if you guys look at the markets recently, we've been seeing a lot of decoupling, right, intraday. And a lot of that is because of the decoupling on a higher time frame that we're seeing, which is what S&P divergence is. So if you look at last week the Dow raged higher and took out a high. We see at the same time, NASDAQ was unable to take out the high, and the S&P was also unable to take out its high. S&P did do a bit better, reaching higher into premium targets. It did get into these highs here. It did get into its respective gap here, and then it did probe into its rejection block here. So to get into that, which is the highest close here. So ES was a little stronger on the upside, but it also failed to take out this high. At the same time, again, the Dow did, and NASDAQ failed too. So if this S&P holds and we see the factors that we talked about here, which is very simple, we want to see it stay below this gap here, and more specifically below this wick here on Thursday. If we see those factors stay intact and the S&P holds, then these downside targets should be delivered here in short order. So there's NASDAQ. Cryptocurrency here. I'll say what I've been saying for a while. Don't hold your breath for this thing to go higher. Weekly chart here. We saw 3 drives pattern here. Well, here, high, high, high. Strong breakdown, shift in the market structure here. We were talking about this inversion fair value gap, and if you still see here, we're still respecting that here. So nothing that's signaling bullishness for Bitcoin. If we were to see bullishness, it would have to trade down, hit this bullish order block, and see immediate sponsorship out of that and start to rage higher. We're not seeing that. We're seeing it still stay very, very heavy, at least for right now. Working down into the daily chart here. See the market took out the high, broke, took out the high again, broke, took out the high again, broke. So it's not able to see any sustained price run on the upside. And now furthermore, we're breaking down through this low here and starting to break down through this low. So in my mind, Bitcoin is going lower. Coupled with the fact that ETH also is weak here. If you look at how this weekly candle's closing, we traded higher into a mitigation block here, and we're starting to reject that and work lower. So in my mind, there's nothing bullish in the market structure for cryptocurrency. So I'd keep looking for lower as we have been on there, and they just keep bleeding out these altcoins. Altcoins are just getting shredded right now. Link. Which makes sense, right? I mean, if Bitcoin's going lower, the other currency, the other cryptocurrencies are just going to get smoked, right? Yeah, Chainlink is lower. XRP. Yeah, XRP is getting smoked. Yeah, which is no surprise. Bitcoin lower, it's going to drag down the whole crypto market with it. And for those of you guys that know how to read institutional order flow, market structure, you guys have been on the right side of this thing for the most part. So still in this consolidation, this is why I'm not a big fan of trading crypto or looking at it, because it'll go into these long periods of consolidation like this here. This is just really nasty. Same thing here and here. It's just, it'll do this. I mean, there's nice runs in it, don't get me wrong, but there's also nice runs in S&P and NASDAQ every hour as well. So I'm not too concerned with it. But yeah, looking for lower prices on crypto. Metals, yeah, that's obviously the kind of star of the show, huh? Let's talk about metals here. So I want to talk about a little bit as to like why the metals market is going higher and why we're likely to see that continue. If you guys look at this here, this is a chart. I'm gonna make sure you guys can see that okay. Okay, yeah, it came up. Okay, so looking at this here, you guys can see the mouse too. Okay, there we go. So looking at the chart here, what this is measuring is the GDP, which is the gross domestic product, which all that is a fancy thing of saying is what does the US produce in a year? The debt is the amount of US debt that is created each year as well. Well, what we've seen from the 90s all the way up until the 2008 is these have pretty much stayed in tandem, right? That's why the Federal Reserve can have a currency that has no backing by anything of value, and they could print it, and inflation wasn't too much of a killer. But what we're seeing now, starting from 2008, is we've been seeing the debt skyrocket and the GDP not as much. So what we're seeing now is the debt to GDP ratio, the ratio between the US debt and the GDP, is ballooning as the debts and deficits are ballooning as well, right? If you look at the global debt clock, the US debt, the debts and the deficits between what would be a balanced budget is ballooning. And what you see is it's going to continue ballooning as well. The reason that's important is because they're going to tell you that they're trying to bring down inflation, costs are coming down, but if you look at what they're actually doing, they're printing more money and lots of it. And if you understand anything about the financial system, is there's no gold going behind this money. So the only way new printed dollars get money is they have to steal purchasing power from dollars that already exist. That's why we're seeing so much inflation. And now on the back of that, if you guys remember the last couple of weeks, I've been telling you guys metals are going much, much higher. And if you look at it here, silver, 64 bucks an ounce. Silver or gold in the 4,300s. And if you guys remember in the last video when we were discussing, I told you guys people are going to think it's really crazy when we see silver in the hundreds and gold much, much higher than it is right now. But that's going to continue if you understand what's going on, which is the debt is going to keep going higher. And now what are they talking about in the Federal Reserve and the president of the United States? Dropping interest rates. What's that going to do if interest rates are lower? It's going to incentivize more borrowing. More people want to borrow if there's lower cost to borrow in the form of interest rates. So if you actually understand what's going on here, inflation is going to keep skyrocketing at paces you've never seen before because the debt's going to keep skyrocketing. The Federal Reserve also said in the next 30 days, they're going to buy, I don't want to say the wrong number, it's 30 billion or 40 billion securities, treasuries. That is also going to skyrocket inflation. So if you understand that, now there's no longer a mystery as to, well, why has gold been going parabolic ever since 2008? And it's just been ripping higher. Now, it has been held for a while. So the valuation that we've been seeing of metals has been artificially suppressed and rigged for a long time. Well, how do they do that? Well, if you look at most of the money that's in metals markets, a lot of it's in derivatives, which just means it's paper contracts, it's paper money. So they can mess with those markets and manipulate them all day long, just like they do the markets that we trade, right? So gold, the metals have been artificially suppressed for a very long time. And now with everything going on, a lot of money is pouring into this asset class because people with deep pockets also understand what I'm saying. And they understand it as well. So they don't want to hold the dollars that are going to keep being inflated. So they're piling in as well. Also, another very important thing to think about. If you look at the central bank accumulation of metals, it's at the highest levels it's ever been. So if the people that have created this bullshit fiat monopoly money, the Bank of Japan, the Federal Reserve, the European central banks, like all these central banks are in on it, right? They're in on the same game. They're all buying record amounts of metals. So if the people that have created this funny money, if they're trying to get out of it and own real metals, that should be telling you something, right? And that's why we're seeing explosive price runs here. You're not going to know this information though. The news isn't going to tell you until it's too late and we see gold at tens of thousands of dollars and silver at hundreds as well. Now, I'm not saying it's going to go straight up and get there. There can be a lot of volatility on the way there, but just knowing what we talk about here, you can really put yourself on the right side of this trade. And that's why I've been bullish on metals for a while. And if you just understand basic economics, the inflation, how it works, you can also understand why it is probably a good thing to consider. Not financial advice, do what you want with your own money, but good thing to consider and educate yourself on. So there's some insight there on the metals and why we're seeing that. Nobody, man, why are metals going higher? If you understand the basic mechanics of debt skyrocketing, metals have no choice but to go higher because any intelligent person with money doesn't want to hold something that's going to be inflated. And the manipulation, what's really interesting is the reason nobody understands there's anything wrong with the economy, the GDP isn't increasing with the debt, is because they keep running the stock market higher. So your average person thinks, oh, well, they're saying the stock market's going higher, so everything just must be phenomenal. Well, if you look at Venezuela, when their economy collapsed with hyperinflation, their stock market made all-time highs the whole time. So all-time highs while the economy is literally crumbling. And that's kind of what we're seeing right now. So that does not also mean that the market has to go lower, right? A lot of people got burned on that. And when I first started, I started in that camp as well. Oh, well, I mean, if the economy is not good, the inflation is bad, I mean, the stock market can't just keep going higher. Well, you will learn. It absolutely can keep going higher. And then that's where you get those perma bears, right? People that are always saying market has to crash, market crash, market crash. And it will. Like there's a time it's going to happen, but when, you can't time that. They're just going to keep vaulting this thing higher and ripping people's face off that are trying to short this thing. So don't get caught on the wrong side of it. Know it's rigged. Know we're trading the fakery. And it kind of helps you give you that step above perspective so that you understand what's really happening here and you're not confused. All right, and then last thing from my man Kareem, we'll touch on the insights from the day there, as you mentioned. All right, so let me take all this off here. I don't trade with all this stuff on my chart here. David, what's your outlook for 2026? Man, I will say it is very, very difficult to predict that far ahead. And not that we don't have visibility, but just in a climate like we're in right now, things can change so fast. It's really hard to say. What is really cool, what I will say, is if you're a speculator in the markets and you're a trader and you know how to do what it is you guys see me showing you guys like on the YouTube videos, like the trade executions, or for you guys that are in the Discord, you guys see the trades I take, whatnot, whatever. And the free Discord as well, you guys can see that. Once you have that skill set, you can get paid every day, even in consolidations. Like this has been a profitable week for me and a profitable last 2 weeks inside these consolidations. But that's because I know what I'm looking for, I'm getting paid, and there's surgical strikes that I'm able to take. You will also be able to do that with the right skill set. And now why do I bring that up? That's because I always get asked, and I think newer traders think this as well, that you need to have the bias all the time. You need to know what the next 6 months is going to do. You need to know what the next 3 months is going to do. You want to know the next weekly bias. But one of the really cool things is that there's times when that information and that visibility is there, but there's times when it's not. And the cool thing is if you understand how to intraday trade and you understand how these price engines are doing price runs all the time and what levels are going to key off of and when, the cool thing is I can trade without a daily bias every single day and never even need to consult a daily chart and still get paid all the time, every single day. That doesn't mean every trade is going to be profitable. Don't take that what I'm saying, but I can be consistent doing that. So the cool thing is there's fresh opportunity every day, regardless of if there's clarity on the weekly, daily, and the monthly, and you don't have to always know that, because I don't always know that. And I'm telling you here, I don't understand or have a clear understanding rather of where we're going to be in the next 3 to 6 months because of where everything's at. But the cool thing is you don't need to know that to make a lot of fucking bank. All right. So Kareem, to answer your question, Friday analysis. So everything starts from the first data point we get on each day. This is the end dog here, right? So going into this day here, and this is also a very, very important lesson. So I also want to talk on this as well. So overnight, Dylan, why don't you hold trades overnight anymore? Why aren't you swing trading? Why aren't you trying to hold for, your weekly targets? Or Dylan, if your weekly outlooks are so precise and you know where the highs and the lows of the week are likely to form each week, or not every week, but with a high degree of consistency, if you know all those things, well, why don't you just buy the low of the week and hold into the close? I'm not comfortable trading like that. I've told you guys that before. I'm not trying to hold trades overnight. I'm not trying to hold trades over the weekend, because with this climate we're in right now, these types of things are going to happen. And a lot of people got hurt and putting on them with these types of things as well. And this is nothing. This is just a gap down that was, about 150 points. But imagine being in an over leveraged, 5-minute position, thinking, yeah, my stop loss is 10 handles, and you hold it into the close. And who knows what can happen in this hour? Bombs can drop, right? Invasions can happen. Who knows? They can decide that AI is just randomly now overvalued. So now it's going to drop, right? You never know what's going to happen in that hour of trading. And the amount of risk holding trades through that is immeasurable. So for my traders that work with me, this is something I wanted to touch on in the market review and in the message I sent you guys on Friday, but I'll just use this opportunity here to talk about it. This is why, especially for those of you guys that are trading big live accounts, that are working with me, that are slinging some size, this is why you want to be very mindful of holding trades overnight. Especially if you're, because if it's a demo account or the prop firms, all right, it's a reset, whatever, you lick your wounds, you're back at it. It doesn't really matter. But you actually can't even hold trades overnight in these prop firms for futures anyway. So yeah, it doesn't even matter for you guys anyway, because you're not holding trades overnight. But for traders that are trading real funds, live money, and you may want to, okay, we've likely made a low here and I'm going to hold for the continuation higher, right? That's not unreasonable. And then it gaps down like crazy. And now whatever stop loss you had isn't respected. And the measure of risk that creates is immeasurable. So imagine if they would have gapped this thing hundreds of points. What would that do for your position? What would that do for your account, right? So those are things you want to think about. This is why, especially as a live account trader myself, I'm not holding trades overnight. I'm not trying to open myself up to this kind of risk because it's immeasurable. And you don't manage a business with gambling. So with that in mind, the first data point we get, to answer your question, Kareem, I know I keep coming back to it. Sorry, man, I've been stringing you along the whole QnA. All right, so we gap down, but it's important information on the end dog here. And then first thing you want to look at, we'll drop down to a 15-minute chart. And we'll take this off. So first thing we do is we gap down, right? And then what I'm looking at overnight going into New York on Monday is how we use the new day opening gap. What do we see? We hit the low, work lower. So we couldn't even get into lower quadrant or 50%. And then we work lower going into New York. That in and of itself starts giving me indication that it's weak. However, with where we were at present, we have obvious equal lows here, we have equal highs here, and we're in the middle of the range. I didn't have a lot of clarity as to where this market was going to go going into the open. I didn't have any analysis because there's equal highs here, there's equal lows here. My higher time frame bias is bullish at the time. So I didn't really know what we were going to do at 9:30. But now I start weighing these factors out. Okay, end dog broke down, couldn't even get to 50%. Now the next thing I look at, the first reference point I'm measuring every single day when I get to 9:30 now, is the opening range gap. What's the difference between where we closed and where we opened? And I'm measuring those quadrants. And then what I'm looking at inside the opening range gap that opens at 9:30 is I want to see how we trade inside the opening range gap inside of the opening range, which is the first 30 minutes, 9:30 to 10 o'clock. This is how I teach those. I work with the trade, and this is how I'm trading every single day. Once we create this gap, I'm assessing order flow in that first 30 minutes. I want to see how the opening range utilizes this gap. Initially, right, in the first 30 minutes, we look for 50%, half gap fill. 70% of the time it's likely to happen. And I'm generally expecting that in the first 30 minutes. So that's usually my bias. Then I have to assess how we use that information. Well, what did we do? We rallied higher and got the lower quadrant. We showed an inability to even get to 50%, and then we broke hard. And then we trade back higher, use the 9:30 open or the low of the opening range gap as resistance and a bearish order block here with the 2 up close candles, and then we work lower. So now I have two things behind me. I have the new day opening gap acting as a breakaway gap, and now I have the opening range gap here, showing that it can't even get to 50%. Is it bullish or bearish if we can't reach 50% of a gap? Bearish. So whenever I see, something for your notes here, if you ever see an opening range gap left open, that's signaling that we're going to have a big down day. Very similarly, if you see a, where's an example of an opening range gap higher that's left open? Yeah. It's like same thing here, right? We see we have an opening range gap higher, can't even get into it. And then you see how it's like a big up day on the back of that. So you can use these gaps to read order flow. And when I see these types of things, it just gives me more confidence in what I'm looking for. And that's how I was able to take that S&P short here. So when NASDAQ was trading up into this 5-minute gap with a quadrant, I'm on S&P short in this run here. And what it looked like was this run here. So, why'd you elect to go short S&P? S&P was more obvious to me because if you see ES, they left these equal lows here. And then as it's retracing into this 5-minute gap here, it's easy money to see it's going to drop into these equal lows here. Further solidified. So you see this previous day here, this wick, measure that. Then we drop down to a 5-minute chart. You see how it hits the fair value gap here. Hits the fair value gap with that quadrant over top of it. So you can see how it works into that, stays in the lower half of the fair value gap, also hits the quadrant, turns on a dime, and then we have these obvious equal lows here. So it was really easy for me to see ES was going to roll over, and then also look at the same factors on S&P as well. If your market has an opening range gap, it has this data. And you see it couldn't even reach 50% of the opening range gap either, signaling what? Big down days in order. And also, if you look at the 5-minute chart here, we have a breakaway gap here, another breakaway gap here. This imbalance here couldn't even be traded up to the high of it. So when I see this on a 5-minute chart, it's super easy for me to drop down into a 1-minute or a 15-second and take anything short here and just take the elevator ride lower into the equal lows here. So you see there's a lot of factors. The main 3 ones were the 3 gaps that were left open. And I already shared that in the main chat. So when I share this information, it's for you guys to back test it and look at it. I can already do this, right? It's my goal for you guys to have the skill set as well. What you want to do with the information when I'm sharing it is look at what those reference points are that I'm taking your attention to and how it allows you to reach this conclusion. Because then you can see how when it's trading into this gap here, if you know anything about smart money concepts or ICT price action, then you know at this point here, it's impossible to justify this market being bullish. So now you have what? An overwhelmingly one-sided market for bearishness. These are the trades I'm taking, guys, right? So if when I'm going long here, for example, on Thursday, live with my team here, and I'm going long here, I'm going long into what? Obvious equal highs and liquidity here. So what I'm just waiting for is for the market to become so overwhelmingly obvious as to what liquidity it wants to reach for. And then once it's doing that, I'm just using reference points that I have available to me to get in and key off of for an entry. And trading is really that simple for me. So what's the draw liquidity? Is it time of day for the market to run? And do I have order flow in my favor? And if I have those things, then I'm usually shooting in the high 70, 80%. Phone died here, so I need to pull up the chat here. So hopefully that answers your question, Kareem. So a little more detailed review here on Friday's price action. So a little bit more of a detailed review here, showing you the business. All right, so let me. Okay, there we go. RT, like the video? Yeah, please do, guys. Appreciate the reminder, sir. Yeah, if you guys did get some insight, something useful from this video, please do hit the like button on your way out. Over time, US dollar will have less demand. Yeah, for sure, for sure. I mean, anybody with a shred of a brain cell, who the hell would want to park their money in US dollars right now? Understanding what we just talked about. Yeah, it's laughable. So David, what's my outlook for 2026? Hard to tell, brother. Hard to tell. Metals, I'm bullish. Very bullish. Now, I don't trade metals. I recommend you holding the metals themselves, the physical metal. I don't trade metals. So I don't want you guys to think like I'm going in here and like intraday trading or scalping metals. I have everything I need in NASDAQ and S&P, and I never need to trade another asset for the rest of my life. And I can make all the money I ever need just trading this. So I'm not trading those other markets. That's more of an investment. Not investment advice, an investment that you can look into and consider. Raj, when do you trade on the M1? Do you use market or limit? So ideally, right, when I'm trading, I would always use limit orders if I could. But let me show you an example of like what my trades look like, right? I'm getting in the market at times when I'm going to get in and it's going to quickly run to my targets here, right? So understanding that, if I was trading like on a 5-minute chart like this, then absolutely, right? It would be really easy to use limit orders and then, you know, have my limit order to short the gap here, stop loss at the high, target the low. And if I'm trading anything above a 1-minute chart, it's really easy to do limit orders, and generally I do, right? So I would have a limit order here to sell short, my stop order, and then my take profit here. Because that's not my style of trading, I can see that it's going to trade up into here and it's going to reverse. So what I'll do is I'll just take it one step further, right? And then I'll just drop down to a 1-minute chart and then have even tighter risk to reward. So now I'll place my stop loss on a 1-minute chart and have, you know, a 7-handle stop to look to make, you know, 25 to 30 handles. So what I do with this information is you see it comes up and hits the 5-minute fair value gap here. Look at what the 1-minute chart is doing with the bodies at the midpoint. These are things I'm looking for. These are things soon you're going to be looking for when you're reading price well. So you want to see it trade up into the gap, but more specifically, you want to see it stay in the lower half. And now you want to consider, okay, there's equal lows down here, that purple line. Usually my sell side liquidity is red, so let me do so here. So you want to consider, right? There's an obvious strong liquidity here, right? There's a 5-minute fair value gap, which is potentially going to draw lower from. And now what's the last thing you have to consider? Is it time of day for the market to move? And then it's 10:50 to 11:10 is your macros that they say doesn't exist. But that's good. That's funny. That's funny. Let them think macros don't exist. It's even better. That's how you know this stuff is never going to stop working. So it trades up into the 5-minute fair value gap here. It stays in the lower half with the bodies, and then we break here. And then my entry was going short inside the bearish breaker here. So we'll make that red here. Whoops. This is, we're dropping down through this level here. I'm shorting in here. And then I just have a tight stop here. No, a little lower. Yeah, shorted about in here with like a 7-handle stop here. And then letting it run down into the lows here. So I scaled off, exit here. Scaled off and exit here at about halfway from this low to this low, and then the rest came off here at this low here. So just a little scalp there. So that's what I did on Friday. Kareem, to answer your question, when we went into the open here, I didn't have all this clarity. So I don't want you to think like going into the open, I knew all this information here right at 9:30. I didn't. I had to wait for more information. But then once I saw that information, and then I started seeing on a 1-minute chart, breakaway gap, 5-minute fair value gap, staying in the lower half with obvious equal lows. You only need to see this a few times to know it's so obvious it's going to run. And eventually when you start aligning all these factors, obvious strong liquidity, the right time of day, you're going to start having really beautiful trades like this, that you get in and it just drops like a rock or takes off like a spaceship. And that's what you want to trade. But you have to have this convergence of time and price, right? And at the highest levels of trading, this is what you're doing. Taboga, thank you for taking the time out of your day to share this information. Really appreciate it. Yeah, glad to help. Glad to be here with you guys. Islam, I believe the upcoming week is NFP and CPI combo. If yes, what is your protocol for such a week? That's a really good question. It's really uncharted waters, right? Because the government shutdown and them moving all these economic reports around, it is uncharted waters. So all I'm doing is I'm keeping it light. It is also the last couple weeks of December, so I also will be taking it light this week as well. We're going into Christmas, New Year, it's already been a long year, a good year. So with all that being said, probably the next couple weeks, I will be taking it lighter anyway. However, you know, when you have the skill like I'm talking about here, even in like sloppy, nasty, crappy weeks, you can still show up during these key times of the day when these price runs are likely to happen, and you can still get paid. So all that to say, I'm not like doing any specific non-farm payroll protocol. Like I'm just trading Monday, Tuesday because MFP is actually on Tuesday. So it's like, it's not even on Friday. It's in the middle of the month. So for me, I'm just going to be treating it as like a normal high impact news driver. I'm not going to be treating it as like the usual showstopper NFP that we have at the beginning of the week, or sorry, the beginning of the month, the first week of the month. However, it's going to be light for me anyway. So it's not going to be that consequential for me anyway. So I'll be keeping it light, taking it easy. If you want more insight as to when myself and my team are going to be trading, when we're going to be looking for opportunities, then you guys can look at the weekly newsletter that my team publishes every Sunday. Eslam, so I also asked the question about NASDAQ, where price closed inside the initial. Yes, which BISI are you talking about, brother? Are you talking about the daily chart? Are you talking about this BISI here? Yeah, I got you. Yeah, so I see what you're saying. I got you. So you're saying the fact that we closed down or closed inside of it and stayed in the upper half. I do see the point you're making. The reason though it's not the same as like here is because this is the first time we're trading into the BISI. So it's hitting it for the first time and it's staying in the upper half when we're bullish. That's good. The fact that it's coming back into it, you don't want to see. It's already accumulated inside that gap. They've already loaded the boat on their long positions inside the institutional order flow entry drill, trading into this gap here. And they've accumulated inside this bullish order block because it's been using it here to accumulate more long positions to trade higher. There's no reason for the market to trade all the way back down to that gap and still go higher. And then if you guys remember the level we were watching last week that I was telling you guys was going to make or break it for me, was this balanced price range here. And we broke through that. You see when it's bullish, how to use it, support, the bodies will stay in the upper quadrant, rally. But then once we break down through it, you don't want to see that. So those are things that I do not want to see for bullishness. That doesn't mean it naturally automatically makes me bearish, but that's why I gave you guys my analysis is neutral to bearish. Neutral to bearish in the sense that I have targets I can see below market price, but neutral in the sense that it's December. We're still in the middle of the range low, range high. There's a lot of things to consider. Like I said, it's a scalper's market for me going forward. And the cool thing is, as a scalper, opportunity all the time. Yeah, great question. That's all. Joe, thanks, brother. Enjoy the rest of your Sunday. We appreciate you for all you share. Yeah, glad to be here, Joe. Take care, man. Looking forward to crushing it with you next week. All right, guys, we're going on 2 o'clock here. 2 o'clock here. I was also hanging out with you guys. Great questions. Hope you guys took something away from this one, some things to think about going forward, and also more of a reason to lock in and dial in on your trading. Have a good rest of your weekend, guys. Stay safe. I'll still be sharing, making content for you guys as well. Be on the lookout for the One Setup for Life video, which will be out here in a few minutes. Take care. Have a good rest of your weekend. See you guys on the next one.